Hello friend, today we are going to see a very low risk investment option called as not fixed deposits, not equities. It's all about bonds. Everything that you need to know before you put your money into bonds. Well, you're going to see, you're going to understand in this specific video what is a bond, who issues this bond, the second point. The third point which you're going to see is what are typical rate of returns provided by the bond market. And the fourth aspect, what are the key factors which you need to be aware before you put even a single pie into investment of bonds. And the fifth aspect, whether you should diversify your portfolio of your current portfolio into bond market, what is the percentage of allocation you need to devote towards the bond market. That is also what you're going to see in this specific video. You're going to understand in this specific video, the fifth aspect. So please share it to your friends and relatives so that they can also get an understanding about this low cost or low risk investment option, and also understand what is bond all about. This term might be very vague to a lot of people, and how they can benefit by understanding the critical factors before they put the money into the bond market, and what kind of proportion they need to follow when investing into the bond market. So please share it to as many people as possible so they can get as much possible understanding with respect to the bond market. So the first aspect, what is a bond? Well, a bond is a fixed income instrument, just like a fixed deposit, wherein you give your money to the bank and they open a fixed deposit account, and you are paid on a quarterly basis or a semi-annual basis or an annual basis, depending on your selection, depending on the way you want to be paid. You can select that particular option. In a likewise manner, the bond also has something called as the coupon rate. The coupon rate is nothing other than the interest rate, just like a fixed deposit. So, comparison with the fixed deposit, the coupon rate generally tends to be higher than the fixed deposit rates. So now, these coupon rates as well are being paid most likely on a semi-annual basis and at times on an annual basis. So you can take a look and you can give your option of how you want to be paid when you invest into the bond market. So why, before looking at why, let's see who issues this bond. The two key players who issue bonds is the government and the corporate bodies. And why do government issue bonds? The third aspect, why do they issue bonds? The government issue bonds because they want to pay up the fiscal deficit. They want to fund for the infrastructure expansion. They want to go on a rapid expansion. They want to raise capital from the public. So that is when they issue this bond. Mostly you might find bonds like treasury bills, or you could find like government securities, or sometimes in conjunction with the central bank, they could issue like inflation linked bonds or floating rate linked bonds. These are the various type of bonds the government can issue to raise capital from the public. And the corporates, obviously, they want to raise capital so that they can fund for expansion. They want to fund the growth of the company so that they can make more profits, and they go to the public. They issue bonds so that they can raise capital from the public via bonds issue. That is one of the best methods of raising capital from the public. It's the primary method of raising capital from the public, and then comes the equity. So the bond market is, in fact, or the bond or the debt market is one of the largest markets in comparison with the in the capital markets, in comparison with even the equity market. Even equity is like a small proportion of raising capital market, and the bond market, bond route of raising capital is much more in the entire globe with respect to, in comparison with equity. So now that we have understood who and why of the bond, let us understand, what are the typical interest rates that the bonds have to offer the investor. Now this interest rate is marginally higher than the ongoing interest rates of the fixed deposit offered by the banks, or you could say marginally higher compared with that of the 10-year government yields, bond yields of the market. Okay, so you can take a look at the fixed deposit rates or the government bond yields, and those are the interest rates which even the current bonds would offer to the market. And why is it so? We will see why is it so. Why is it closely coupled with that of the interest rates of the economy? We'll see that when we look into the factors of which you need to consider before you invest in bonds. So what are these factors? So the key factors that you need to be aware before you invest into bond, the 5 key factors which I'm going to cover in this specific video. The first factor you need to understand is when the interest rates move high, the bond prices need to correct lower. And why do they need to correct lower? The reason is because they need to correct lower so that the yield of the bond is adjusted to the interest rate, ongoing interest rate of the economy. So the bond prices fall down when the interest rates rises. So obviously when the bond prices fall down, that's the best time for an investor actually to put the money into the bond market. And when the interest rate actually falls, the bond prices of the existing bond prices rise up. So the investor needs to be a little careful. So obviously when it rises up that time as well, because the interest rates have fallen down, it will match the ongoing interest rates of the economy. But is it good for the investor? Well, if you're a short-term investor, well, you can enjoy the current yields of the bond being a short-term investor. But if you're a long-term investor, you want to invest for the duration of the bond, the best is to opt when the interest rates are actually high. So that was one of the key factor, interest rate. And the second factor is you need to calculate a few ratios. The 2 key ratios is the nominal yield of the bond and the current yield of the bond. So nominal yield of the bond, you take the annual interest rate payable by the bond, that's the coupon rate payable for the year, and divide it by the par value of the bond, that is the face value. And generally the face value is about 1,000 rupees. In some cases it is 5,000, and in some cases even 5 lakhs. Okay, so you can calculate the yield and compare them with respect to the ongoing interest rate, and then decide whether it's a worthwhile option to invest in the bonds at that particular price. Well, the third ratio is about the current yield of the bond, which is one of the key factors before you invest, other than the nominal yield. The current yield is more important because you will be dividing with the current price of the bond and the coupon rate. So obviously in the high interest regime, the bond prices will fall down. So that is the reason the current yield will also be higher. And a current yield which is higher is the best time when an investor needs to put the money into the bond market, so that they can get advantage of not only the coupon payment. You know, for example, the bond is paying 10% coupon payment on a par value, and the bond corrects further down. So the yield also obviously goes up, and if you wait for the entire duration, you get paid, you know, the difference between what you get paid, that is the face value of 1,000 rupees compared to the low price which you paid today of maybe say 900. That difference also you can enjoy. You enjoy also capital appreciation on the bonds. Can you believe that? So that's the third aspect. The fourth aspect is bonds are issued either it could be taxable or non-taxable. So depending on your tax bracket, you need to choose a bond which is paying a specific rate. So now how do you calculate this? How do you identify whether the non-taxable bond is more beneficial than the taxable bond? So what you do is you take the tax-free yield of the bond, of the tax-free bond, and divide it by 1 minus the marginal tax bracket. So that will give you to what extent beyond which you can invest into taxable bond. Below that you can invest into non-taxable bond, and beyond that you need to invest into taxable bond. So this is the formula. If you need some help, please drop a note, please drop a comment. I'll be glad to put in the formula. Nevertheless, I will do mention the formula in brief in the description box. So that was the fourth aspect. The fifth aspect which you need to consider, you need to calculate the duration of the bond. When I say duration, it's not the duration to expiry. Well, that plays a key role, but duration measures how sensitive the bond price is with respect to the interest rate changes. For example, 1% rise in the interest rate, how much percentage the bond price is likely to fall, so that you can understand the risk and then accordingly invest into the bond market. You need to consider the duration of the bond called as the Macaulay's duration. And how do you calculate Macaulay's duration? So Macaulay's duration in fact indicates how risky the bond is with respect to the interest rate changes. For example, if a 1% rise in the interest rate, to what percentage the price of the bond will actually going to dip. So that determines the risk of the bond, and that gives you a clue whether you need to invest into that particular bond today or wait in the future. Okay, how do you calculate Macaulay's duration? The way to calculate Macaulay's duration, you need to identify all the coupon payments year on year, and once you take the coupon payments year on year, you divide the coupon payments with the yield to maturity. You divide every coupon payment by the yield to maturity depending on the year of the payment. You need to raise the yield to maturity to the power of the year. And then once you sum it all up, once you sum up all these present values of all future cash payments, that is the coupon rate cash payment as well as the future value cash payment, final, once you divide all the present values, you divide it with the current price, that will give you the Macaulay's duration. Once you identify the duration, then you can decide for yourself whether you want to lock into that particular risk or not. So if the Macaulay's duration turns out to be like 4 years, it literally means for a 1% rise in interest, the bond price is actually going to fall by 4%. Now, Macaulay's duration may not have much value for a person who has invested into the bond right from the market and wants to wait till maturity. For that person, well, he'll be paid the maturity benefit anyway, and he is getting payment every year or semi-annually. But it's significant for a person who wants to sell the bond in the secondary market. So Macaulay duration is one of the key factors which one needs to consider. And how to calculate this, you can put in a comment box if you're really interested to know how you calculate Macaulay duration. And most of the websites, most of the apps, when you take out the bond, the Macaulay duration is also being provided along with few other risk parameters of the bond called as Sharpe and Jensen's ratio, standard deviation. All these aspects are provided in the app. So make yourself comfortable and look through all these ratios, look at all these 5 aspects before you invest into the bond. Now, so the final aspect about a bond is when do you need to invest in the bond? Like if you are in your teens or if you are in your retirement age, should you invest in the bond? Now it is because it's a fixed payment instrument. When you're about to retire, it makes sense to avoid the volatility of the market, and hence thereby your ratio in the bond market needs to be higher. Now to what extent higher, it depends on your risk appetite as well. So I'm not going to give a rule here of how much you need to invest in the bond market. It's all depending on your risk appetite. If you're in your retirement age but your risk appetite is high, you can choose to invest more into equity still in comparison with the bond market. But if your risk appetite is low, then you might choose to invest low into the equity market and high into the bond market. High could mean even 80%, low equity could be like 20%, or it could go 100% into bonds as well. It all depends on your risk appetite. But for a person who is in his teen, having a long duration of investment period remaining till he retires or till he serves any financial goals, if there's a long period more than like 7 years or 8 years, then he can invest into equity. But if he has a period of a short-term requirement, then he can go and invest into bonds. But nevertheless, the ratios, if you're in the teens, the ratio in bonds is ideally lesser percentage with respect to equity. So in here, for a teenager, it could be 80% equity and 20% bond. But you need to also remember what are the financial goals. If you have a short-term financial goal, then you need to invest equivalently into bonds or into instruments which are having low volatility and having guaranteed cash payment and principal payment as well, or even capital appreciation when it comes to high interest rate regime. So that was all about bonds. So I hope by going through this entire video you have understood what is a bond about and what are the key factors you need to consider before you invest in the bond, and what are the ratios we need to be aware of when you're investing into bond if you're a teenager or middle aged or almost closing to retirement. So if you want any help, please drop in a comment and I'll be glad to get back to you over your email ID. See you until then. Enjoy.